Learn Account Podcast by Professor Accounting, Episode 17, Partnership Accounting, Dissolution, Realisation Account. Welcome to you all. I've received many emails about this particular topic, so I've put this to the top of the list, and here is a podcast on this topic. Hope you find it useful. So the realisation account, I'm going to make this brief. I've been trying to record this several times, and either the file is too big or something, some issue, so I'm just adapting what I was going to do, and I'm just going to go do an overview of the ledger. Let's look at first of all the ledger. So take obviously a note of what I've got here. This is a realisation account which I've completed just with some typical entries that quite a lot of entries that you may have. You probably wouldn't have as many as this, but I want to go through the each individual item and just mention about these. I've already got numbers in there. I'll explain them shortly. So first of all, let's just think about this as a ledger. This is a T account. A ledger. So there should be some function as to this ledger. What I mean by function is a role or a rule. And if we look at the rules that I tend to teach, you'll see something like this from your teacher or from accounting. We've got to learn about debits and credits. So a debit, depending on the name of the account, will reflect an increase of an asset. A credit will be a decrease of an asset. An increase of an expense, a decrease of an expense, or an increase of income and a decrease of income, being the opposite. Capital going down and up, and so on and so forth. So if we had any account being called heat and light, well, we know heat and light is an expense, and we therefore know the balance is on the debit side. Likewise, if there was a fixed asset, such as the vehicle account is obviously an asset, so it's a debit balance, and so on and so forth. You've got all these accounts which have a role. Now, the realisation account, you can treat it as an expense account, an asset account, but actually it's all accounts, it's any account. You just use the ledger rules in the realisation account to help you. And remember why you do that. So you can take this if you need it. I'll put it full screen just for a second if you want it for a big format. That's my notes that I use. And the realisation account is, think of it, this is dissolution of a partnership. So the partnership is ceasing to trade after you've tidied up the accounts. So you're winding up the partnership account. So this is the only ledger you're going to be left with. So this has to work. This has to be treated as any account, in which case we've got assets on the debit side, expenses on the debit side. You've got decrease of assets on the credit side somewhere, and you've got income on the credit side, and you've got as well profits and losses and so on. Or well, you'll have one of them anyway. So there is no one answer for the realisation account. It is not an asset account, it's not an expense account, it's not an income account, it's all accounts being put together. That's the way you need to think of it, and it's so useful if you think that way. Let's look at the items I've got here on the debit side. So any fixed asset is on this side because we're transferring them by closing off the individual asset account, fixed asset account, and transferring it to the realisation account. So we credit the premises account and machinery account and vehicle account, and then debit the realisation account. The same for stock debtors, in which case we are basically moving assets to the debit side as well. I'm going to mention this debtors issue because in some questions you've not seen debtors before, and how we approach that. We get net debtors. You may have seen discounts allowed. Well, that's typically the way the exam board does it, but they could easily give you it this way, and I'd rather go through it just in case. So I'm going to go through debtors in red and debtors in red over here in a short while. Any expenses on the debit side, typically got dissolution costs. So that's the expense on the debit and the bank is being credited. We've got on the credit side any sale or disposal. Well, that is the income from the proceeds. So it's debited the cash book for the assets of cash or money, but it's the credit side because it's an income. And the same for these. The debtors, this will be the money we receive, the income, and then the cash book, the money we receive for stock as well. On further down, we've got here the items taken by the partner. Well, this is where obviously the partnership may want to keep certain fixed assets. In this case, the vehicle. In this case, so they're taking it out obviously a little bit cheaper than it's worth. They are making a loss because it's worth £9,000. They're taking it with 7.5. But rather than numbers at the moment, just look at the rule. This is an asset going down. So remember, the vehicles have been transferred to this account because it's closing up the business. Well, if you've got an asset on the debit side and you're going to be taking it out for the partner's private use, then you've got to credit the realisation account to reduce assets. So that's why you've got it on the credit side. Also, where's the double entry? It's going to the capital account. Now, if you think about an owner taking out a fixed asset, this is the only account you've got left. So you're not going to realise money in terms of selling money to, because you just think of money as capital, because assets equals capital. So if the owner takes out an asset, which in this case they take out a vehicle, then we simply reduce assets, so a reduce capital. So the double entry will go to the debit side of the capital account for whichever partner it is, X, Y, or Z, for the value. Creditors, this is other income, other revenue, we know that from AS, so it's the credit side because it's other income, and it's debited to the creditors because that's going to reduce liabilities. Credit entry in the creditors being an increase of liability. So that's your approach essentially. I've just put numbers in there. I mean, you can look at the numbers how I've used them. Premises 45,000, and in this case, we're not sold any, so they're going to be exhausted. I could sell them on, I suppose, in this example. It just means that if they're not realised in the sense of being sold off, then we're going to make a significant loss. Machinery, though, I'm selling, so 25,000, 21,000, so it's a £4,000 loss. Obviously a lot less, but still a loss. The vehicle being taken out, small loss. So essentially you can see there's going to be a loss on realisation here, and you only ever know that until you look at the balances at the bottom. Let's just look at this debtors issue here. So to date, the exam board AQA have only ever given you a question where you have to reflect discounts allowed. So let me just show you this method first of all. If you are ever given a provision for doubtful debts in a question like this, this is the approach you need to take. So any provision for doubtful debts, it needs to be in the balance sheet or at least stated in the adjustments. They could be even crueler with regards to calculating the PDD, or they could be a little bit kinder with regards to giving you the new value for the year. So I'm just going to use that. Let's say debt is £33,000, and then you've got to, that's excluding any bad debts that have been written off. Yep, that you need to write off, because obviously you have to write them off in this section here when you write trade debtors. And then you've got PDD to work out, or maybe it's given to you for the year, whichever way it is. So let's say that's 6,500. Then it's not increased. It shouldn't increase. So I need to change the maths there. So it's not increased, I need to do minus. There we go. So 26,500 is our new value. That is the value that needs to go into net debtors into the debit side of the account. I'll explain discounts allowed in a moment, how you see it, but let's just finish off this approach first. What we then do is we then say, okay, that's the amount of debtors that we should receive, that owe us money, I should say. How much do we get from debtors is on the credit side here. So we're typically trying to get £26,500 from debtors. Now that's incredibly difficult to get the amount of money at the point in time we need, because we're realising the account. So we may not get any. We probably won't get all debtors, but we have to incentivise. We have to give them a reason to give us the money now, because we want to wind up the business as quick as we can. So we might give a cash discount. Discounts allowed. So in settlement for that debt, 26.5, we might get £24,000. As just an example. I need something lower. Well, that difference between money received and money owed to us as a business, the value there is £2,500. Well, that is discounts allowed. So in this approach here, you have to, if you are given PDD or expected to work out PDD in some way, shape or form, then you need to use this approach, and you need to put the net debtors and the debtors in this case to show those values. The 6,500 in this case is only taken into consideration with a calculation. But in the case of that you've always had, if you have discounts allowed to incorporate, then the way you be told that, or the way you are told it, is the debtor's value you're told in questions is my value of 26,500, and then you're told that they settle their accounts for 24,000. So then the difference is either they either tell you it's discounts allowed, or you need to know it's discounts allowed. So all you do there is, using the same numbers that I've used, it's £2,500 is the value you need to use. Well, all you would do is net it off. So the process of netting off, which is a contra, making the same entry in the debit and credit in the same account, which is essentially what we're doing here. Not strictly contra like in cash book, but you basically have debits exceeding credits by 2,500. So you could just write there discounts allowed. I'm not going to. Discounts allowed, and you have 2,500 over here, and therefore you'd have 0 over here, nothing over here. So they're still benefiting by 2,500. The totals will be different, obviously, like they are. But the net difference is this is 2,500 higher. So that's all you have to do in discounts allowed that you've ever had to do. But in questions, the question I've just shown you there with PDD is not that much different, but you need to take into consideration Don't do the netting off. Actually do both values. So put it back to what I've got, and that's what I've got here. Lastly, let's now look at I've got values in there that I'm using, and in this case, an observation. I'll come on to this depreciation bit as well with some tips. But let's look at loss and profit realization. We add up both sides. Glance, this side is lower. When credits are lower than debits, it'll be a loss on realization, because if this is all assets, if that's assets and that is what you sell them for, then you're obviously making a loss. If it's the other way around, if debits are lower than credits, you're making a profit. Okay, most of the time it's loss on realization. Here's how we do this. Find the difference between the two totals. Obviously you wouldn't write your answer here because you need to use pen, so do it like a working somewhere. Totals of the columns. Difference is 54,000. That's what we need to share. So 54,830. We find one part, and that's using the PSR. So if X gets 1/4 and Y gets 1/4 and Z gets 2/4, which is a half, I had to use the 4 though, then you need to divide that by 4, to get this, and then that is what is shared between the ratio. So one part is one part, and 2 is twice the amount. And the total of the parts must equal the value of the sum of difference, which is 54,830. So now, if I copy these values just over to here, I need to, because I've got cell reference, using formula can be a problem. So now I'll delete this one. Okay, so these values now need to go basically in here, and then if you put them in there, the picture look nice, all wonderful blue, and this one can be yellow. Then you notice by adding those values, the totals agree, and they should agree. No balance CD, no balance BD, but they agree. So that means you've now ascertained that it's a loss on realization, and state that with the capital names of the whatever they are. So you wouldn't need to write this on the debit side, the profit realization. You would only have one on either side. You would never have a profit realization as well as a loss on realization. So only writing what you need. So remember which side they go on as to why, in terms of capital being higher. Assets, if assets are higher, this is assets, and expenses are no. But if debits are higher than credits, then you're making a loss. Because think of it as selling and gaining. You're selling what you gained, but you're selling it for lower than what you gained, so it's a loss. That's the way I think of it. If you get the other, then it's just the opposite. Okay, another thing to mention is, I'm going to put this on a tip slide in a moment, but we've got to look at depreciation. It's never given as well. So like the PDD, if you ever get that, this is the way to do it. Depreciation is given. So anything you put in here with regards to fixed assets, the value there, you just put the value in that they tell you. That value must be net book value. It has to be net book value. Because if you are, for example here, if I was to have depreciation in this question, the premises might have been £50,000 and ACDEP, accumulated depreciation, might have been £5,000. So therefore, £45,000 is correct. But if that was the numbers that I had, I didn't have any numbers actually, but if I told you that is the cost, and then 5,000 depreciation total, just as an example, if I had put 50,000 in there, that's cost value, then clearly I'm not realizing any. I'm realizing the premises, but I'm not selling them because they're not in this side here. I don't have to sell them unless I can sell them. But it's a lot of capital that you're actually losing out on. But you're losing out here on 45,000. That's what is incurring this loss. £45,000 is one of the factors. But if I hadn't used the 45,000, which is the correct value, and I used 50, it would make it £5,000 worse. So it wouldn't be prudent, because first of all, you're not depreciating or taking into consideration, and it's going to skew the capital values, because the profit and loss and realization will be inaccurate. So if you haven't been given this at any time in the past, if you are given depreciation in this kind of question, you must take it away from the cost values and therefore give net book value. I mean, there could be, depending on how many marks they want. Again, they've never done this, but it's certainly scope in the question. You could have to calculate the PDD. Again, you can do all this. It's AS. And calculate the depreciation for the year, but don't forget NBV. It takes into account ACDEP, all depreciation. So just something, just a food for thought to think about, but you must have NBV in there. So a summary of calculations. This creditors, when we actually pay off this creditors, there's a phrase that is mentioned in the book, but we say it's discharged. We discharge our liabilities or discharge our creditors. That's a phrase that isn't really emphasised. We discharge them. Essentially, we're paying it off, but we acknowledge that we've paid up to date. So we discharge that right to have paid off the creditors. I don't know if it will come up in the exam, but it's a phrase that I tend to mention when I'm teaching this. Here are some tips that I think you should be aware of. And I've already mentioned these. So typically, it's the more difficult accounting entries that I find students fall down on, and again, it depends upon if the exam is using them. But you got to use the ledger, the rules of the ledger. So if I put this on, I'll do this first to show you any accounting image as a last slide. Any provisions such as bad debts or PDD, we've got to net off, and I've shown you that. Bad debts, you just have to take them away before you do the PDD. Again, it's AS stuff, but you've got to do that in the question. Depreciation as well, you need to net it off the cost of the fixed assets. So essentially there you're transferring the balances, those numbers that I mentioned, to the credit side of the asset account. So if you've got debtors ledger, the bad debts and the PDD would go to the credit side of that account to give you net debtors. Depreciation goes to the credit side of the fixed assets to give you essentially net book value. And if you notice ledgers, cost, fixed assets go in at cost in one ledger, depreciation goes in another ledger. That's when you have to bring them together, because this is closing off the partnership. Right, discounts and creditors, this is given in the question usually, but students fail to use it sometimes and fail to acknowledge it. So the balance the creditors account, in terms of the ledger, we transfer the discounts on the creditors to the credit of the realisation account. So we have to, basically they're to the income side, isn't it? We have to put the discounts received on the credit side of the realisation, and likewise the discounts allowed. But you wouldn't do discounts allowed directly if you have to do number one. As I've shown you in the example, you would use the net debtors and then the sale of the debtors on the credit side. Transfer the balances of the partner's current account to the capital account. Again, that is something that students forget to do. Some questions, in all fairness, they tell you they've already done it, but most questions have to transfer the current account. Remember, the current account is still classed as capital, so when you're winding up a partnership, you are essentially redistributing capital back to the partners, and you have to obviously redistribute the current account capital well. A partner who owes the firm money because his capital account is in deficit must now pay the money owing. We cannot have negative equity. That's what it's called, negative equity. So it's where capital balance, if you finish your answer and your capital accounts have a balance, well, if they have a balance BD or balance CD, you've done it wrong anyway, because this is a dissolution question, and you shouldn't have anything because there's no new accounting there. But when you're working out the values, if it looks like because the partners will receive money back because of the capital they have, if it looks like one partner or seven partners, maybe one, they owe money to the business, then that is actually probably what it is, because they have a negative capital balance. So therefore they need to put money, their own private money, back into the business, into the partnership, to neutralise the negative capital account. As well, lastly, the exam question, AQA. There's a couple of questions I've seen in AQA where they do partnership question, but they incorporate it inside an incomplete records question. It's hard for what the question was, but it didn't go through partnerships as much as you might think, because it has to teach incomplete records as well. Okay, so again, just thinking about this in terms of the partnerships. So lastly, let's look at my image. The way I want to treat the account, just briefly look at my layout. This is the debit credits, so any account. Debit side is reflecting assets and expenses, reducing of capital liabilities and losses, and the credit side is any decrease of assets, decrease of expenses, increase of capital, increase of liabilities, and profits as well. So you're using that. If I minimize this a little bit or smaller, if you're using that and you're comparing it to the ledger that I've shown you. So very briefly show, then you've got the assets on the debit side, well, increase of an asset. You've got, again, more assets. You've got expenses, dissolution costs. Well, there's the expenses, the increase of expenses. You've got here, this is income. Proceeds is income from the disposal. Again, income from debtors, income from sale of stock. You've got capital Here, this is the owner taking out a vehicle. Well, that's a decrease of an asset, because remember, the vehicle is now here. So to remove that vehicle because the partner is taking out, it's a credit entry in the account. Income, credit discount received as income. And then lastly, the profit or loss. Now be careful, losses is the debit. This essentially is looking at the perspective of the P&L, or capital. So the loss of realization, a loss is mentioned here, but it's not that account we're looking at. This is the realization account. So the loss on realization, when you make the loss, if you do a ledger for the P&L, or in this case the capital account, it will be on the debit side, which is what this is stating. Losses on the debit side, this is the double entry, and profits on this side. So utilize a ledger, learn these. They're so important for AS, and obviously most of you watching this being for A2, incredibly important you learn these, because you can see how fundamental it's so important to learn it for realization. So realization account is the last account left in a dissolution, so it operates using all rules of debits and credits, all the accounting equation rules. And don't forget the accounting equation: assets equals capital minus liabilities. Assets equals capital plus liabilities, and then you can rearrange it with capital equals assets minus liabilities. Typically the horizontal ledger, which is this one here, this is assets on debit, and the capital liabilities credit, which is the way ledgers operate. So that is the approach to working it out in terms of the realization. So treat it in that way, and you shan't go wrong. Hopefully you found that useful. Short podcast. Hopefully it's been useful. I want to thank you for stopping by. My contact details are here. Again, please do rate the video so I know how well I'm performing and how useful you find them. Again, comments please on the board, and emails as well through YouTube and so on. And let me know obviously any further topics. I've got a list of topics still to do. I'm getting through them. Hopefully find them useful, and I'll continue doing them until I move on to further topics. So thank you for watching. I'll see you next time for another podcast from Professor Accounting.